And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the Hump Day edition of The Real Investment Show. It is Rocky the Raccoon Rescue Day. Animal Control has decided they will show up this morning to rescue Rocky. He's still alive apparently, because I got home from work yesterday and both my dogs decided to take everything out of the fireplace to try to, make sure that, he's okay in there. So I walked into the house yesterday. Of course, my wife has this very expensive white carpet in our living room that is now covered in soot, footprints, and a variety of other fireplace accoutrements, as they say. So
I wondered how long it was going to be before the dogs got in on the action.
That was yesterday while I was at work. So anyway, today is not only cleanup day, but is also rescue the Rocky the Squirrel Day. So Rocky Racoon Day. So we'll get that taken care of. Anyway, so now you're up to date with my latest saga. Yesterday, markets broke the 50-day moving average. We're going to talk about that a bit more this morning as we do our market update. But a few other things going on. Yesterday, retail sales were exceptionally strong. Came in at 1% yesterday at the headline number, 0.7 at the core. And so again, that was kind of really the reason for the sell-off yesterday, was because this exceptionally strong retail sales number says, well, nothing's slowing down right now. In fact, the Atlanta Fed GDP is now forecasting a 5% growth rate for the economy in the third quarter. Now, let's put this into context. 5% growth in the economy, very, very strong retail sales. That means that inflation is still present at this point. And so, this is going to keep the Fed kind of intact for being focused on fighting inflation rather than potentially cutting rates. And so that was the reason for the sell-off yesterday, was this idea that the Fed may not be able to cut anytime soon here, especially if that kind of data keeps coming in. Now, sure, there's some anomalies that always occur in the July retail sales report because it's back to school shopping. You also have Amazon Prime Day that also kind of fosters into higher retail sales numbers. But nonetheless, it was a very strong number, suggests the consumer is not slowing down at all right now. Doesn't suggest that the impact from higher rates is being felt as much as had been expected at this point. That means that, of course, inflation is probably not coming down anytime soon further, right? So we've come down from 9% to 3% on inflation, but we may be stuck here for a bit. One of the things that a lot of people are starting to ask the question about is whether or not the Fed raises its inflation target. Now, you remember that when the Fed first announced their rate hikes, they said our goal is to hike rates until there's a clear trajectory of inflation back towards our inflation target of 2%. Now people are starting to ask the question, are they going to raise that to 3% and say, okay, well, we're good at 3%, so as long as we're at 3%, we're okay. So that's kind of the hope that, okay, if we're at 3%, then the Fed can cut rates again. That's probably not going to be the case, but again, we'll see what they say at Jackson Hole in the next week or so, because this is going to be the big question for the markets, is this whole yields versus inflation versus economic growth, recession. What happened to the recession call last year? It never occurred. So again, these are all the questions coming out, but certainly right now, the economic data does not suggest that there's a recession anywhere present or that inflation is under control yet. So again, this is going to keep the Fed pretty much focused on at least maintaining interest rates where they are, but also potentially, may need another rate hike or two from the Fed if we don't start to see these kind of economic data points start to slow down to make sure inflation is under control. Now, today, we have the FOMC minutes, so the markets are going to be focusing closely on what was said in the minutes of the last meeting. Now, again, these aren't real meeting minutes, by the way. These are carefully crafted and tailored notes from the meeting, right? But again, normally meeting minutes has, what everybody said, good, bad, and different. Well, you're going to see a carefully crafted set of notes that are coming out from that meeting. But again, it'll be carefully analyzed to see really what the tenor of the Fed is. Is the Fed leaning more towards cutting rates, or are they leaning more towards hiking rates? This is going to be the hotly debated thing after the minutes are released this afternoon. But again, this all comes back down to, ultimately, what does this mean for the markets? Because, again, this, higher rates of inflation suggest higher interest rates. That's certainly not good for long duration assets. So stocks should be correcting in that environment. But again, we just had 5 of the strongest months that we've seen in quite some time for the markets in this rally. So here's what you need to know before the bell this morning. Yesterday, the market did break the 50-day moving average. Now, a one-day break of the 50-day moving average is not a be-all, end-all, so don't go out and sell a bunch of stuff today just because we broke the 50-day. Here's what's important about that. The market needs to recover that 50-day moving average by the end of the week. So again, you can break below it, but as long as we get back above it, we're okay. If the market fails to get above the 100-day moving average, then the next logical kind of support level is going to be right around the 100-day moving average, which is currently around 4270 on the S&P 500 index. Markets are getting a bit oversold here. Now, again, we talk about this MACD sell signal, and this is important because this is kind of what drives that ebb and flow of the markets. So we're getting back to the level that normally the market kind of bottoms for the MACD. So the MACD oscillation is getting back to levels that normally exist during bullish markets. Now, again, when we get in a bullish market, the markets are trending bullishly, these oscillations are a lot smaller. When you're in a bear market, kind of that correction period we had last year, those oscillations are a lot deeper. So we're now back into a point to where these oscillations in the MACD, this buy signal, sell signal type oscillation, is occurring at a level. So again, that MACD is getting down to a level where normally markets are getting oversold enough to now generate a buy signal for the next rally. Again, we could slop around here for a little bit more. The MACD could go a little bit lower here. That wouldn't be surprising. We are getting fairly oversold on a short-term basis as well. So again, we've kind of getting this market kind of set up here for at least a rally for a couple of days, just kind of a relief rally after the bout of selling that we've had. Again, then what would happen from there is going to be kind of the next question. Can this market rally back to new highs, continue its trend, or do we have more consolidation? My expectation right now is a bit more consolidation in the markets over the course of the next couple of weeks, maybe into September, and then we get set up for that October, November, December rally kind of into the end of the year. And that would also align with kind of normal seasonal tendencies of how markets trade. Outside of that, if we take a look at the Qs, very much, kind of the same picture we're seeing in the NASDAQ as well. Took out the 50-day moving average. That oscillation also, again, in the MACD sell signal, getting to a level that's kind of more normal for a sell-off in the NASDAQ. Small cap, mid caps, when we get into to that range, that's a very different story from large caps. Large caps have done very well this year, the NASDAQ, the S&P 500. Mid cap, small cap stocks have really gone not anywhere. But again, we are kind of taking out some of these levels on the markets here. The MACD sell signal still in place here. Took out the 50-day moving average, very much the same as the large cap and small mid cap and NASDAQ. Support is, not too far below where mid cap, small caps are currently trading, getting fairly oversold. So again, it's the same story whether you look at S&P 500, the NASDAQ, mid cap, small caps, all kind of look the same right now, breaking those initial levels of support at the 50-day. Need to recover that, hold there and consolidate a bit, or we're going to get a little bit more of a sell-off as we go into later this month or September. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. Got a lot of stuff to talk about. Interest rates, CDs, where's the best place to put money, why I'm buying bonds, all that coming up on this morning's edition of The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So Futures about flat this morning. S&P's down about 3 right now, but again, as we get closer to the open, we'll start to see that kind of shore up a bit. This morning, we've got housing starts, building permits, kind of another look at the housing market, which is showing some signs of life, actually. So starting to see some improvement there. Industrial production, capacity utilization, as the economy starting to kick back off. We've talked about before is that, these economic data cycles, we're getting very long into the tooth of a down cycle in that economic data. So start to expect to see, and again, we saw this with retail sales yesterday, these better than expected numbers. So you can start to kind of expect this, and this is going to, kind of be a process that we go through. Again, just, as we wrote about last week's article talking about market and economic cycles, we're just very long into a current down cycle. So you're going to start to just see some improvement, even if it's just based on year-over-year comparisons. You'll start to see improvement in that data. So again, we'll get some more data out today, and then of course as I said earlier, kind of the focus of today will be the FOMC minutes from the last meeting, where they hiked rates by a quarter point. What was the consensus about further rate hikes? Was this kind of a one and done thing? That's really what everybody's going to be parsing those minutes for. So again, that'll be kind of moving markets later on this afternoon. Outside of that, though, lots of other stuff going on. Danny Ratliff joining me this morning. He always gets lots of questions during the week, so lots of stuff to talk about. Also, Bob Dole asking 5 questions about today's market. So, I guess that's one of the big things. Yeah, Bob Dole's always bullish. So, you almost guarantee that he's going to be expecting markets to go higher from here. What's he asking? What's his question?
I've never seen him not actually somewhat bullish.
Right.
In one way, shape, or form.
It's easier to be bullish all the time, right? Because bear markets are short, bull markets are long, so it's just easier to be
you'll
bullish.
Be right more often.
Yeah, exactly.
Yeah, no, that's exactly right. So we are getting lots of different questions. I think Bob Dole, he came out at the beginning of the year with, his top 10 predictions of the market. And so really what, they're thinking is, okay, does everything continue to line up in the sense of, we've seen this great growth within, what everybody would call the Magnificent Seven. Now we're beginning to see a little bit of a pullback in that area. Mm-hmm. Do you start to look at maybe more cyclically weighted types of indexes, like maybe an RSP, or looking at mid cap or other areas that could potentially outperform because they're not as highly valuated at this time?
Right. Well, I mean, we've been talking about seeing cyclical rotations in the markets anyway. It's just a function that, everybody was piling into a few stocks earlier this year, and then now they're going, oh, look, there's some value over there that I didn't get. Maybe those stocks will play catch up. So everybody does the same thing, right? So everybody goes and chases the other stuff, and so it starts to play catch up. That's not surprising. It's just kind of the way markets work.
So what about the bond market, how correlated it is to equities at the moment, right? The higher we see yields, that's typically not going to be potentially good for the economy and the market in general. Mm-hmm. How does that line up?
Well, I mean, as we talked about in yesterday's article on, interest rates and yields and, debt and all those type of things, is that when you talk about interest rates as a function, they negatively impact long duration assets. So who's right? Is the bond market right at current yields, or are stocks right at current price levels? And this is the question that you've got to kind of figure out for yourself, because if you're betting that interest rates are going higher, you certainly don't want to be long stocks because of the negative impact of interest rates on long duration assets. So you don't want to be in stocks if you're betting that interest rates are going to go higher. If you're betting on stocks going higher, then you have to be betting on lower yields as a function of that, because lower yields support long duration assets. So you've got to make your choice as to what you think is going to happen and then make your bets accordingly.
Yeah. So we continue to hear more and more about a soft landing, especially as we continue to get data that's, it's pretty much more resilient than I think most anticipated, but we are getting conflicting data in other regions, right? China's beginning to slow down, which is in some ways helping the inflation front with cheaper prices in that aspect from what we're importing. But what about this soft landing narrative? I mean, we continue to hear about it. Obviously we're seeing inflation's been stickier, but do we have to get a recession to really get things back and kind of recalibrate back to normal?
No, you don't. I mean, and the one thing that everybody kind of overlooks is that we just had a recession, right? So we just had a recession in 2020, and it's very rare to have, recessions back to back to begin with. It has happened before. We had back-to-back recessions back in the late 70s. They were a couple of years apart. But it was a very different environment back then in terms of, what was going on with the oil embargo and a variety of other issues that were weighing on the economy. So you had these two very close recessions. But normally, recessions occur average about every 8 years. So there's nothing out there that says we have to have another recession because we just went through one. So people kind of shut down spending. They did everything you would expect to do during a recession. Of course, we combated that with a tremendous amount of liquidity. And there's still, as we noted in yesterday's article, M2 as a percentage of GDP remains extremely elevated. So, there's still so much money and stimulus still floating around the markets and the economy in whole. It's not surprising that we continue to see more resilient numbers in the economic data. And again, we've been through as I just said, we've been through a very long down cycle in this economic data as well. So you start seeing improvement in some of that data. That's not going to be surprising, and that's going to continue to push out this recession narrative. And is it possible that we can avoid a recession? Absolutely. Is it likely? I don't know if it's likely we avoid a recession entirely or not. I still suspect you have a very kind of soft recession or recession in late 24, maybe early 25, as you kind of work through all this. One kind of caveat to this, and people are starting to finally debate this a little bit more, is the impact of the restart of student loan payments. That's going to be roughly $150 to $300 on 40 million people. So split the difference, you're talking somewhere, $10 to $12 billion a month in spending that doesn't get spent in the economy because it's got to go to pay off debt. So is that enough to slow down the economy? We'll find out.
Yeah, very likely. So what about, Moody's just recently downgraded a lot of banks, so their credit ratings were downgraded. A lot of concerns in those areas, and we've seen that in not just the banking sector but others as well, especially as lending policies are becoming more stringent. Mm-hmm. But now the Fed's Kashkaris came out and said, "Hey, we're going to look at more banking regulation, especially on mid and small regional banks." Is this a buying opportunity? Are there going to be a lot of mergers and acquisitions? What do you see from there?
No, I would be buying banks. And we own a couple of small mid regional banks, and we'll probably buy some more as we kind of go along because. Again, the banking system is pretty much the lifeblood of the economy. So, let me ask you a question. Are you going to stop banking?
No, but I think people are beginning to. I think people are starting to look and say, hey, look, you're going to have to pay me more to keep my funds in one spot, right? And in general, I think that people are very prone not to move, right?
Right.
And big banks are banking on that.
Right. But who pays more for money, regional banks or major money center banks?
Well, regional banks are, but... At what expense? At some point, how bad do you mess up their profit margins because they have a lot of debt on the books it's very cheap. Mm-hmm. They're having to pay more and more to incentivize investors or depositors to keep money with them. This can't be something that can continue for long periods of time.
There's a lot of money in major money center banks that can move to regional banks and not really move the needle. Yeah. So, again, I wouldn't count small and regional banks. Look, you have to do your research on any stock that you buy and make sure that they're well collateralized and, they don't have a lot of exposure. But look, the one thing that is still sitting out there too that is a concern is commercial real estate. And, a lot of small to mid regional banks have a lot of commercial real estate exposure. So you have to really kind of figure that out a bit. But again, at the end of the day, there's going to be winners and losers, and there's going to be banks that fail, and they're going to be absorbed by their banks, just like we saw with Silicon Valley Bank. Mm-hmm. So you try to pick some winners and that are going to be, kind of the aggregators of other banks that go under.
Things can materialize really quickly. So what do you say to somebody who says, all right, Lance, great. How do I find out how much commercial real estate somebody is dealing with? Like a bank.
Look at their 10Q.
Yeah, but how many people know how to read that?
Well, then you shouldn't be investing if you can't read a 10Q. It's not hard.
Yeah, no, I hear you.
It's their financial statement's pretty much laid out in it.
But I think there's also maybe some stuff that's underneath the surface that many people can't see in the sense of like how many loans are they, which sectors, which industries.
It's all in the book. It's all in the 10Q.
No, but
everything's in the 10Q.
No, everything's in the 10Q, but you're not seeing, some of the business risks that they're taking with other businesses. You can't tell that, right?
Look, there's a risk to everything that you do. I can't tell what Mark Zuckerberg might do with Meta tomorrow.
Yeah.
Right? I have to look at what he's done financially in the past, or I can't tell what Raytheon is going to do tomorrow.
but I can look at what they've done in the past and make some pretty good assumptions about, what trends of sales are going to be, what their average risk is relative to their debt, those type of things. I mean, you can make some assumptions. There's no guarantee of anything. That's why it's called risk-based investing. You take a risk to put your money at work.
Yep.
And you risk loss. And so again, you try to make your best guesses that you can, and then moderate your losses by, if it's not working, you sell it and move on.
So we touched briefly on this, but I want to step back real quick. So a lot of questions still around tech, right? Tech has been the big driver for the first half of the year. We talked about market breadth just being terrible. Now we're seeing a bit of a breather in that region, sector. Is that something that, you see people coming back to, and that's still that AI-driven narrative for the remainder of the year?
That's a function of passive.
Yeah.
We talked about this before. I mean, you're not going to get away from passive investing. There's too many people now that don't buy stocks, they buy ETFs. So every time you buy an ETF, you're just flooding money into Apple, Nvidia, Microsoft, Google, those companies. So, right now, tech is selling off along with the rest of the market because you're just getting a broad rotation out of stocks at the moment. So, but when that returns and money starts coming back in, when you get your next buy signal, money comes back in, tech's going to lead the way because of the passive flows. And that's just the new markets that we live in now. So just buckle up because this is going to be the case for a while until people figure it out. We'll be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Yeti Holdings, which is the overpriced mugs. And we're just going to run up to the lake for the weekend, and our cooler broke at our house. We're running late, and so I just ran into Academy real quick. I was not paying attention. I grabbed this Yeti cooler bag. It was large enough to throw some drinks in. We could throw it, get it on the boat, etc. I wasn't paying any attention at all. Get up to the counter, drop this Yeti cooler on there, and I'm like, cool, man, I'm going to be in, I'm going to be out, we're going to be on the road, it's great. He goes, that'll be $230. I was like, what?
The Real Investment Show podcast.
He's like, yeah, it's $230. I was like, it's a cooler. This crap is expensive.
The Real Investment Show podcast. Same show, your schedule.
That cooler, I'm going to be buried in that cooler. No coffin for me. Bury me in the Yeti cooler.
At realinvestmentadvice.com.
Because it was more expensive than the coffin.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. New tune there from Brent. So,
Yeah, no, great tune. Actually, that was sent in by a client, Sean Smith. We appreciate that. So thank you very much. Long-time listener.
that's awesome.
Yeah.
That's a great little that's a great little lick right there.
Man, that's some good chops.
Sean, send some more. We need more. So, yeah, send some more.
As I understand it, he's playing all the instruments on this too.
At the same time?
Yes, he has 8 arms.
Oh, Sean, that's talent right there, man. No, that's really good piece.
Yeah. No, that is awesome.
So, yeah, definitely send some more. We need it. We used to have this other guy that was very similar to that, Leo
Maraccioli.
Yeah, who played all the instruments and made these great riffs. And we actually bought a license from him so we could use his music on the show. Then Google says that we can't use his music because we don't have a license, even though we're standing here with a license. So just go figure that out. Thank you, Google. We appreciate it.
Well, he had a lot of tunes that were pretty similar to other things, right? But
no, he did covers.
They were dead on.
Yeah. But again, nonetheless, we had the license, and Google argued with us that we didn't have the license, even though we bought the license and we proved that we had the license. They said we didn't have the license. Anyway, it's Google.
Fun
so,
stuff.
Sean, unless if you don't have copyright issues, send us some more music. We need it. So,
Dude.
exactly. So we went through the 5 questions from Bob Dole, kind of rapid fire last segment. So got that out of the way. What else is on your mind this morning? You've apparently got lots of questions.
Well, yeah. I mean, obviously we see any type of market pullback, you do get a lot of questions. And I think that it's, obviously
we've been
very
talking about a
warranted.
market pullback for 2 freaking months. We said, hey, market's overbought. You're going to get a 3 to 5% correction. Well, here you go. It's an opportunity to buy some more. In fact, we bought some more yesterday.
Well, but I think you see headline news, you see everything else that's going on, and it is concerning. And you think about where is this actually going? And as quick as things materialized this last year, do you continue to see this type of run up, or is it a larger, broader pullback? Your thoughts have been that this is going to be something that can continue for a bit.
Yeah,
but
a couple months.
So a couple months.
Yeah,
Okay.
month to 2 would be completely normal,
Yep.
and you get a pullback, somewhere to the 50 to 100-day moving average.
Which we're at the 50, right?
We're at the 50, and so you could go to the 100, and it's not the 200-day is not out of the question. That'd be a 10% decline. Oh my gosh, 10%, completely normal in any given year. We've talked about this before. So what's happening right now is completely normal. You had 5 months of an advance. Everybody was all excited about the advance. Well, you got to have a pullback, and you have a pullback here so you can have another advance at some point. And so you'll have an advance into the end of the year as portfolio managers play catch up. So yeah, use the pullback now to buy stuff.
So, that's a really good point, because I think frustration for many this year has been that, you may be invested, and if you're in any type of broadly diversified portfolio, you're not keeping up with the broad index just because of what you're talking about.
Right.
The passive investments, the Magnificent Seven, those big stocks have been doing extremely well. And so as you're trying to step back into something like this, do you go back to those same positions because of that passive investing?
Well, no, it's never a good idea to chase 5 stocks.
Yeah.
Right. Eventually, you're going to have a much bigger correction there than you expect. So no, you continue to build a well-diversified, allocated portfolio across sectors and across markets, et cetera. That's why we own some small mid caps. We own large caps in different sectors. And again, you've got to have the Apple, the Microsoft, the Google in your portfolio. You need that. But, there's also other opportunities out there. So when you do get cyclical rotations between sectors, sector rotations, market rotations, et cetera, you have assets that can, kind of pick up and limit, downside drag. So, again, the goal is not to have no downside. If you're invested in the markets, you're going to have some downside risk. The goal is just to minimize that downside risk some degree. So if the market's down 1 and you're down 0.5%, that's great, right? I mean, that's kind of what you're looking for, is just, when the markets are down, you're just not losing as much as the market. So again, a good, well-diversified portfolio that's throwing off some dividend yield and some interest income, work. And right now we've got some bifurcations going on in markets because of what's happening between, 7, kind of tech stocks, AI-related stocks. Bonds are under pressure right now simply as we still kind of work through this inflation narrative, which will eventually go away. And then once bonds get back on their horse, then you're going to have a very different shift to the markets at that point as well. So again, when interest rates start to come down again, and they will, then you're going to start to have, long duration assets, begin to outperform better as well, just because of the function of lower rates. So again, this is, we're just going through a transition period in the markets over the last year or so. We're getting closer to the end of that than not. So, this isn't the time to be making mistakes. You've got to start kind of thinking ahead of what the next couple of years is going to look like.
So that's a really good point. It probably leads to a big question and a lot of conversation that we're having internally here with clients is that, hey, I've got funds on the sideline. They're sitting in cash or in money market. Money market right now, you're getting paid close or over 5%. But let's go lock in on a CD or a short-term bond. Terrible idea. Why do you think that?
Because it's going to mature.
Well, terrible in what instance?
Well,
if it's really short, it may be terrible. And I don't know I'm not going to say
this is like, okay, so here's what I'm saying. It's like you got to make you when you're investing, you've got to think longer than what's going to happen over the next month, right? This is the biggest problem with investors. They look at, what my portfolio did from January till now. That is completely irrelevant to the long-term picture of things, right? You've got to be looking forward and saying, okay, where are things going to be in the next 2 years, 3 years, 4 years? That's what you're investing for. And so if I buy a CD at 5% today, that's great, right? Except stocks are going to beat the crap out of you through the end of the year. And then you're going to be going, well, I've got money locked at 5%. And the market just yanked out 10. Why am I in this CD? So you go sell your CD to jump back into stocks right when they're that they're overbought again. We just saw this happen earlier this year. Remember in January, everybody was buying short duration bills because, I can get 5% of my bills. And then they all wanted to sell their bills to jump into stocks because stocks are up 15%. That's what's going to happen. So no, don't go buy. Look, if you've got money that you've got to use in 6 months or a year for something like down payment for a house, college tuition, buy a car, CDs are awesome for that. So any money that you need a really short-term use for, CDs are awesome. Buy a CD, put it away, forget about it, and then when it matures, go buy your house, whatever it is you got to do with it. But never make a long-term investment decision based on short-term rates because those 5% yields are going to go to zero. It's just a function of when they do. Whether it's 6 months from now, a year from now, or a year and a half from now. But at some point when the Fed cuts rates back to zero, and they will, those rates are going to be mature. So here's the problem. So I go put all my money in a CD paying 5% today. Those CDs are callable. So as soon as yields start to come down, the bank calls you up and says, oh, yeah, we're calling your CD in. And the Fed won't cut rates, by a quarter point here, and then maybe 6 months later, a quarter point there, and then 6 months later, a quarter point after that. No, the Fed's going to cut rates from 5% to zero literally probably within the function of 3 or 4 months. And your CD is going to get called, and your next CD you're going to get is zero. That's going to be how fast it moves when it occurs. So don't lock yourself into something. This is a problem with buying short-term treasury bills. When those bills mature, where are you going to go? Because when yields drop to zero, stocks will be too overvalued to buy. And now you're stuck with really this limbo between I've got no yield on bonds, so the only thing I can do is buy stocks, which are overvalued. That's the risk you're running.
Yeah, I mean, I think that reinvestment risk is the biggest risk out there, unless it is truly short-term funds that you're going to need in the not-so-distant future, and you're fearful that you're going to essentially, you're going to see money market yields drop significantly.
Yeah, no, look, let's be really clear about this. If you've got money with a short-term need, you do not invest that in stocks, period. End of story.
Yeah.
Because stocks are risky. I get people email me all the time. It's like, oh, I'm thinking about buying a house. So where do I invest my money? Cash. You don't put capital at risk that you're going to need for something else, because again, you never know what this market do. We could have something happen that nobody's expecting, because this is how it happens. It's nothing we expect to occur. It won't be a recession. It won't be anything else. But one morning we're going to wake up to something and the market's going to be down 20, 30%. And unfortunately, that's going to happen right at the time that you need your capital. That's always the way it works. It's just Murphy's Law 101 and how it works in markets. So never, ever, ever invest capital that you need for a short-term thing in the financial markets. Cash, CDs, perfect for that. Don't do anything else.
Yeah, I think that's great. So anytime you need short-term funds, this is okay, those CDs. Now, one thing you did mention is those callable CDs, and I think that's one thing that needs to be looked at. So we look at CD rates, we look at bonds, T-bills, look at all of it, and try to see what type of spread's different, what it means for somebody, and especially within certain time frames. So we are seeing a lot of callable CDs that are paying quite a bit more than what a normal CD that is not callable. And say you want to go out 3, 4, 5 years, you may not have that CD for a long period of time. So anytime there's a callable CD, I'm telling most people, hey, you need to look at this, as it's going to be called, and maybe it's only a 6-month CD or a 1-year CD, because most of the time, if this thing goes the way we anticipate it will, and Fed funds rates do drop over time, that short end of the yield curve is going to go down pretty quickly. So like Lance just mentioned, that at that point you face reinvestment risk unless it's really truly short-term funds. So you do need to think about, is it worth maybe getting a little bit less in yield to have that bond or CD not callable, and you actually can capture that for a much longer period of time.
That's right. And look, it's always about opportunity risk, right? If you make a decision based on one thing, one factor, you always subject yourself to opportunity risk. Look, I've got cash in accounts that pay 0 because I never know from one day to the next when that cash is going to be needed for some investment opportunity.
Well, that's dumb.
Right? So
it's terrible. No, you don't get 0 right now. It's too easy.
0.
Too easy to get paid.
0.
Too easy. Don't do it.
Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Pretty amazing. And welcome back to the show this morning. All right, Danny. Keep it going. Danny with questions this morning. He's got lots of questions. He sat around all last night just trying to think of questions.
Oh, man, they come fast and furious, and especially with volatility. So,
Yeah.
No, it's good. But so, there's a new article out, Lance, and I know that you have a strong affinity towards this, and it's Social Security.
Yeah.
And so, they're talking about right now how Social Security cuts are going to happen in 2033 at this moment with the current tax receipts that we're receiving. And it'll be a 23% discount to what people are receiving or should receive here in the future. Now, my thoughts is that something will be done, and they're going to have to. The problem is, politically, this is something that most of these guys don't want to address.
Right, it's football.
Yeah, and we're running out of time, right? You have a 10-year time frame, and the further and the longer you wait, the worse the problem gets.
Sure. Especially when you keep spending the way you're spending.
Correct. So what are your thoughts on Social Security being actually taken care of? And
Well, so as I've said before, it's a math problem, right? So
it's a demographic issue.
It's a demographic issue.
Yeah.
It's a math problem. You had 16 people paying in for every person taken out originally. You're now down to less than 2. We have a demographic trend, and then of course all these policies that we're now promoting in America, across the board, doesn't promote demographic growth, right? We need more people at home having babies. If you want a strong economy, you've got to have more babies. But
they won't have them quick enough to put them in the workforce.
This is a problem, right? Yeah. This is why it's a math problem. And you can't immigrate your way to solve the problem, because the immigration that we have coming in right now is not the type of immigration you need to promote a higher income earning class. We need more people paying into Social Security, yes, and everybody that works will pay into Social Security. So yes, we can immigrate, a lower end working class, and yes, they'll pay into Social Security, but they pay less because they make less money. So you need more
thoughtful immigration,
right? You need merit-based immigration, like we used to have, which is come here with money, create jobs, etc., and you collect more tax revenue. So we need population growth, both immigration-wise and population-wise. We need to move back towards our generation to where we promoted growing families, and that's a focus. We have more and more young people. They are opting out of having kids altogether. They don't want to get married. Take a look at people's views on marriages. Those are declining sharply. Take a look at the number of people that go to church and have faith. That's been declining sharply in recent years. And why is that? The reason that's important is because that's where a lot of the thoughts on marriage come from, right? If I have a strong belief in faith, my belief in faith says I need to be married to my partner, and that I need to be faithful to that person over time, have children, have family, etc. Create family. That's part of the faith process. But that's what leads to stronger economic growth, and that's the only way ultimately that you fix Social Security without having to just slash and burn it entirely, which is the bad outcome that Richard always talks about, talking about people having to step over bodies, because people depend so much on Social Security. So it's not an easy fix. And the problem is that we messed up Social Security back in the 60s when we started giving it to everybody else other than workers. So originally Social Security
the program just expanded.
Right, we just kept figuring out more ways to give out more money to more people, widows, orphans, firemen, you name it. And every time we turned around, it was like, oh, yeah, let's just take this group of disenfranchised people. We'll put them on Social Security or Medicaid. When people come in, if they don't have access to stuff, we'll just put them on Medicaid and give it to them. It's fine. I don't have any problem with that, other than the fact we can't afford it and that there's not enough money going into the system to support all the people that are taking out of it. So at some point, it's not fixable. You can't just, tweak it here and say, okay, we're going to raise the retirement age by a couple of years, and then go slap a whole nother group of people on it, taking money out of it. That's not going to fix your problem.
Well, you've got to shut the door on one side if you're going to find a way to fix it on the other, and that's
Correct.
The problem. But
right.
So the issue is, Committee for Responsible Federal Budgets, U.S. Budget Watch 2024 proposal believes that there's going to be a $17,400 average cut for a newly retired dual income couple in 2033.
That's correct.
So that's $725 a person.
Yep.
Now, we know the stats. Over 50% of retirees currently need Social Security or use it for more than 50% of their retirement income.
Right.
A quarter for 90% of it. I mean, you think about if you had a cut of that, $725, you want deflation? It's coming. I mean, right?
Well, this is where we get back to the other problem with this, right? And this is why you see such, rising calls for socialism. You see rising calls for all these other type of programs because so many people are disenfranchised and so many people do need or want more money. And I thought it was a very interesting article out the other day, kind of talking about the younger generation that's coming up, right? They feel disenfranchised. They feel left out. They look at, the rich people, all the baby boomers, they have all the money. I don't have anything. I can't make ends meet. And the article is how am I supposed to work a 40-hour week when I have to sleep for 8 hours? I've got to work for 8 hours.
You have to do how long?
Yeah, I got to sleep for 8 hours. I have to work if I have to work for 8 hours, then how am I supposed to do all the other stuff with the remaining 8 hours, right? And I've got to wash dishes and clothes and clean my house and do all these things that and eat, take a bath, and that apparently fills up the entire other 8 hours. And this is why there's this push to work fewer hours, right? I need a 35-hour work week versus 40s because the claim was in this article, I can't work. 40-hour work week made sense back in the 60s when the wife stayed home from work. I thought that was really interesting that they would make that comment. But when the wife stayed home and took care of all the stuff at home, I could afford to work 80 hours a week. But now that traditional role isn't there, the 40-hour work week makes no more sense. Here's the problem with all of this, though, and this is why everybody says, give me more free stuff, is that there's this gap between what we think our lifestyle should be versus what reality says it should be. And we live so far beyond our means. And we don't save for retirement. We don't plan for retirement. We don't do the things that we need to do. And again, the baby boomer generation did. They had 60% of debt to net incomes. They had high savings rates. They worked hard, they saved their money, they didn't live extravagantly beyond their means, and they saved this wealth and they invested it and they started businesses and they did these type of things. That's why the wealth is there. We haven't taught the generation that's coming up that's complaining, we haven't taught them to be responsible with money and to take advantage of the opportunities that are there. So that's where this disenfranchisement has really come. And again, it's not just their fault. It's the Fed's fault. It's zero interest rates for 13 years. It's one monetary intervention after another. It's sending checks to households. It's all the things that we've done that have really just distorted the way the economy works. But, at some point, Danny, if you're going to fix Social Security as a function, you've also got to fix the economy at the same time. Because they're part and parcel of each other.
No. I don't disagree. Now, there are ways to fix Social Security. I mean, we can remove the cap on how much income is taxed. I mean, they've talked about that in the past with different bills, removing it and saying, okay, at this amount, we're going to cut it off, but then at 300, 400,000, we're going to start capping or we're going to start taxing it again.
I just think you got to take the limit off.
You just take it off altogether, yeah. But I think that's what most people, especially on the more high income earners, frustration is. They're like, wait, proportionally, I pay in so much more than somebody else, yet I'm not getting the same proportionate amount. I mean, they're getting more, but not by proportion. That's what's frustrating, I think, to a lot of people.
No, it is, and but this is also the other misnomer of Social Security. It's not your money. The money you pay in for Social Security is for everybody else. Yeah, it's not your money. There's not an account with Danny Ratliff's name on it. It says, okay, Danny paid in $1 million in Social Security over his lifetime, so he's got $1 million to draw on in retirement. Maybe that's the way we should set it up, but that's not the way it works. The $1 million that Danny paid in over his lifetime is paying for all the other people in the system. That's why it's called welfare. It's a welfare system.
This is not considered welfare.
It is welfare. It is a function when the
it's
government.
It's a Ponzi scheme, is what it truly is. I mean,
it is. But when the government gives people money, it's welfare. It's a welfare system, and that's why it's entitled. That's why it's called an entitlement.
Yeah, but you're actually putting those funds in over time, right? So it's not your.
It's
typical
not your
welfare.
money. It's everybody else's money.
But you put your money in, so you don't think they're tracking those dollars? They don't. How do you think they cover these numbers?
Yes, they track those numbers. They track how much Danny put in, but it's not your money. It's everybody else's money.
Well, correct. I'm not getting my physical dollar back. It's not an account in my name or your name.
And that's why you're going to get...
Oh, Jesus. I just realized I'm going to be paying for you.
Exactly.
Good Lord.
And that's why I'm retiring soon.
Yeah, good luck.
I'm going to claim Social Security early just to piss you off.
Plan looks terrible. And you're setting all kinds of bad examples. Having money in an account earning absolutely nothing to...
Because I use it day to day.
Yeah. No, I get it.
Every day.
Hey, day to day, that's fine. But yeah, any other cash sitting on the sideline.
I'm talking about very small amounts of money.
Your checking account, okay.
Yes. Yeah. It's just because I never know when there's an opportunity I want to take advantage of.
Yeah, I get that. That's fine. And keep it at Fidelity and earn 4.98 and...
Yeah, absolutely.
Yeah.
No problem. Any other things? You got about 20 seconds before we wrap up the show.
Well, I think we can say this for next week, but I was at a wedding this weekend. I visited with a bankruptcy attorney.
Sam, that was really great.
And I thought this was, but I thought this was really interesting. We were talking about like his business and like COVID, how it impacted him. And he said that he was super busy with small businesses as COVID hit. And then it slowed down. He said summer months are typically pretty slow, but they had picked up. He's like, this is the busiest summer I've ever seen. And I don't know if it's just the guy's gained more popularity, he's got a good reputation, or is this something bigger?
No, I look, a lot of people are spending money. There's no doubt about it. I mean, retail sales just showed you that, right? So there's just a lot of money in that they're still out there from the elevated savings rates we had post. And this is why I keep saying that, this recession everybody's expecting, it's going to come eventually someday, but it may be a lot further out there than a lot of people expect. This is kind of expecting that we're going to have a recession next month, next quarter. It may be a lot further out there than you think.
Yeah.
So, all right, wrap up the show for the day. So many things I want to say to Danny. Anyway, wrap up the show for the day. We'll be back tomorrow with Michael
Go ahead
Leibowitz.
and take Social Security. You'll still be working. You won't get anything.
I know. I just want you to pay for it. Wake up with Michael Leibowitz tomorrow. Talk about the Fed minutes. They come out today. We'll get into those tomorrow. Of course, get by the website. Michael Leibowitz's new article out is on the website now. realinvestmentadvice.com. Have a great day. See you back here tomorrow.